as more lenders report their full-year earnings, Joshua Odebisi, a senior banking analyst at Vetiva, joins us now to unpack some of those numbers. Joshua, thank you so much for joining us. Let's begin to unpack, maybe starting with Stanbic IBTC that reported recently. I do know that you were somewhat disappointed by the fourth quarter performance. Can you just tell us what you think are the key takeaways from these numbers? Because Stanbic is one of those banks, in my view, that sort of stands out in terms of its diversity of its earnings base. It's not the real core it's not the core lending business that drives earnings, but we've seen it really emerge as a financial supermarket, especially with the asset management and investment banking business. So tell us what you're learning from those Stanbic numbers and what those could tell us about what's to come from other lenders.
Thank you for having me. I think you hit the nail on the head when you said that Stanbic's earnings are very diversified because their core banking business is not profitable. So again, this year what we saw was that their full-year earnings, their gross earnings, a large part of it was came from their non-interest income, which is their non-core banking business. So again, we saw gross earnings actually 5% below our estimate. That's why it was a little bit disappointing. It came in flat year on year, but then we saw loans and advances grow by about 17%. So they were very aggressive with growing their loans, but the income from those loans did not go up significantly. On the other hand, we saw non-interest income across various lines, their fees and commissions, their income from investments, and other income go up. Overall, I think the most important thing is that even though their provisions did go up to almost 10 billion, they still posted profits of about 83 billion. So I think overall, Q4 was a little bit disappointing, but the bank still managed to pretty much raise their profits year on year, which is an encouraging sign, I think, overall, because there was a lot of concern.
But Joshua, I think many people are concerned about what we're likely to see from the banks in 2021. Does that fourth quarter number point to what you're anticipating in 2021 in terms of perhaps potential weakness in bank earnings moving forward?
Well, there are different ways to look at it. I think obviously there were a few challenges, but Q4 for some banks has historically been a very weak quarter. I think a lot of the activity we normally see comes in Q1 and Q3 for most of the banks. Those are usually the bank's strongest quarters in Nigeria specifically. So I think we shouldn't read too much into the fact that, earnings were a little bit down. I mean, okay, in the case of Stanbic specifically, earnings quarter on quarter were severely down. I mean, across all line items, from gross earnings down to PAT, everything was down by pretty much double digits. But overall, I mean, economically, I think there was still a lot of activity that happened. I just think that maybe there were a few challenges here and there. Overall, I think maybe the biggest issue that we should, be looking at is the fact that were people able to, start repaying back their loans? Because obviously the restructuring did not push back all the loans for, maybe more than a year. So if we're not able to see a bit of a recovery starting in Q1, then we might start to get worried that economic activity is not recovering to the level that would support a growth or a return to normal for interest income and even other income line items. So there are a few challenges here and there, and I think the biggest issue would be if those recoveries don't start to happen, then provisions would really start to go up, and that will now have a big impact on profits. But I don't think we're really there yet. There's no cause for panic just yet, but we're getting there.
I mean, you certainly sound quite optimistic. We'll see. But let's quickly speak about First Bank. ABN Holdings reported its numbers and, of course, boosted by divestments of some of its non-core business. And you are actually rating it as a buy, and I do believe you've actually reviewed your target price slightly higher. So what do you like about ABN Holdings?
Well, okay, the truth is the biggest takeaway or the biggest encouragement for them overall is the fact that they managed to keep their provisions pretty much flat year on year. Last year they did provisions of about 50, 51 billion. Um, we had expected it to go much higher, but that did not happen. So I think that was a very encouraging sign, because if any bank was going to, see provisions spike by an alarming rate, we thought it would be First Bank, obviously due to, their legacy issues even before the pandemic. So when that did not originate, it sort of caused a little bit of optimism that maybe the bank has gotten things under control and has been able to manage, their loan portfolio. Although their NPLs are still quite high, if they're able to, maintain this kind of momentum and do some more restructuring and maybe rest off a few more of their loans this year, we might start to see that NPL go closer to, the regulatory limit of 5%. Now, if they're able to do that while maintaining, their pretty impressive non-interest income and maybe managing their net interest income, not allowing it to slip too far, then we might start to see, the kind of profitability growth that we've seen from, our other top banks, your GT, your Zenith, and your Access. Now, if that starts to happen, maybe with time, the bank will be able to offer the kind of dividends that those top banks offer. Obviously, it all hinges on them being able to manage their NPLs and get them down, close to regulatory limits. That's really what would, boost that. So the reason why our rating went up slightly is because of those revisions.